There's gonna be a lot of us that day because we're keeping it at a 90-degree and like we're changing the.
All right, you'll have the table across then.
Yeah, like the table be across. And this camera apparently is a sensitivity based, so if we're talking, it'll move to like us.
Ah,
So whoever's talking will have the camera.
really?
Yeah.
Nice. I think that sounds pretty cool, actually.
Fancy.
Yeah, fancy. We need it. And what about the slides themselves? Will
Um,
they be? Well, we'll talk about it on Wednesday when we do the.
yeah, I think it would be on.
That's the idea of the
We're
test.
doing a pre-dry run as well on Tuesday because he wanted one before the day off. He said it's too tight for him if anything is wrong with the visuals.
Okay.
So we're just replacing, like we'll just keep Tom and Mariam instead of you and Dinesh if you
Yeah,
can.
because
Good morning, everyone. I hope you're all seated comfortably. We're starting Tax Matters in approximately 2 minutes. Thank you. Good morning, everyone, and welcome to Keypoint's September Tax Matters. It's a pleasure to have you with us this morning, wherever you're joining from, wherever in the globe, your house, your office. It's nice to be talking to you and talking all things tax in the region this morning. We have a fairly packed agenda, which given the amount of changes that are happening and continue to happen across the region. So we have a number of matters to discuss, which you will hopefully find intriguing and informative. For those of you who haven't heard my voice before, I'm George Campbell and I'm the head of tax at Keypoint across mainly Bahrain and Saudi Arabia, but covering the region. And I'm joined by my co-hosts, Raman Ori, who is our direct tax leader, and Tariq Haq, who is our VAT key point man, and Abinaya Thermalai, who is our one of our shining stars, our assistant manager, who will be leading you through some matters to do with economic substance and country by country reporting. I know in those matters of agenda, we have had a number of changes that have occurred in regional tax, and it's not just VAT. We are used to the introduction of VAT causing complexity, many challenges which businesses are having to overcome. It was a new tax when it was introduced, and many changes came with it that businesses had to adapt to. But we're starting to see a maturing of the tax environment across the region, and obviously jurisdictions such as Saudi Arabia have had tax for quite some time now, but even then that tax system is subject to change and reform to really pull things in line with global practice, and the rest of the GCC economies following suit, either introducing new taxes or changing things to adapt to global needs and their own budgetary and government spending needs. So a number of changes, and then there are regulatory matters. So just to run you through what we'll be talking about this morning, on that regulatory point, we will be covering some of the further restrictions that SOCPA, which is the Saudi Public Accountants Organization and governing body, has placed upon auditors with respect to the services that they can provide to their audit clients. Now, this is a big change, and Raman Ori will run you through what this is really going to mean for Big Four organizations, large mid-tier firms in Saudi Arabia, and for the businesses themselves. It is a large step change. There will be some disruption from this, and it's something that's really important that we cover this morning. We are used to certain restrictions with respect to public audited, statutory audited clients, but these changes go further and place further restriction on the services that can be provided. We'll then talk a bit about e-invoicing. That'll be Tariq that will run you through that. Another seismic change in the way tax is administered, moving towards effectively a system of real-time information and a vast amount of data being available to the ZATCA in Saudi Arabia. And we know that other states, GCC jurisdictions, are looking at introducing a system of e-invoicing as well. We'll go back to Raman after that, and he will talk through some of the changes that will impact transfer pricing. And then we will ping pong back to Tariq, who will talk us through some of the impact or the opportunity that ZATCA's amnesty initiative is going to offer. After that, we will hear from Abinaya on 2 points, being economic substance reporting, mainly in relation to Bahrain. Of interest to Bahrain businesses, and the same with country by country reporting. After that, we will have a Q&A session where we will answer some of the questions that have arisen as part of our presentation that you have for us, and we will do our very best to answer those in the time available. So please use the Q&A widget to ask us anything you want to ask about what we're presenting, or indeed any other tax matters. I'm sure we can find the time to help you. And with that, I will pass over now to Raman Ori, who will lead you through the changes that SOCPA has recently introduced on businesses providing statutory audit with respect to the other services they can provide.
Thanks, George, and good morning, everyone. Let me begin this morning's webinar by giving you the updates from Saudi Arabia. And the first one is the the Saudi Organization for Chartered and Professional Accountants, SOCPA, in March this year, endorsed the recommendations by its Professional Conduct and Ethics Committee on non-audit services. Essentially, with effect from 1st of July this year, so it's already in effect, auditors, statutory auditors can only perform 7 types of non-audit services, which are listed in the circular and is on the screen for your reference. So broadly speaking, the services that can be provided by the auditor are in relation to the audit itself, or maybe ancillary to it, assurance related work, valuation services, tax filing services, and also in certain instances where they have to assist their clients with regulatory reports as required by the industry watchdog from time to time. However, there is a caveat to all this in that the sum total fees that is generated by non-audit services should not exceed more than 70% of the fee that is charged for the statutory audit. And the key thing here is the onus is on the audit firm. So if you look into the detail that's on the circular, it refers to the fact that the people who are charged with governance at the audit firm are required to notify the client, i.e. the audit committee, on the services that they can perform going forward, and also the fees that they would generate from that, just so that no rules are broken. So as I said, this is an onus and really puts auditors in the spotlight when it comes to offering their non-audit services. Now, the question is, obviously, why has SOCPA done this? For some time now, there has been a perception within governments, regulators, and shareholders, both internationally and now in Saudi Arabia, that some of the actions taken by the very large auditing firms or mid-tier firms isn't necessarily in the interest of the business community or public at large. And therefore, time has come to enforce this, and thereby forcing the audit firms to split their advisory and audit services. Saudi Arabia has obviously heeded to that, and what SOCPA is trying to do here is to assure the wider business community as well as the various stakeholders that it intends to clamp down on any issues that may arise in relation to audit independence or conflict of interest. At Key Point, we are not a non-audit consulting firm, so not bound by these rules, which puts us in good stead as we can provide the full range of tax services, both compliance and advisory, both across all taxes, that is the direct tax, indirect tax, and international tax services. One thing I forgot to mention, and it's a very, very important point, is that tax advisory or litigation related services are specifically prohibited. So they cannot be done and are not subject to thresholds. So for example, if you have received an assessment from the Saudi tax authority, ZATCA, and you wish to file an objection, or the matter is listed for appeals, from 1st of July onwards, your statutory auditor should not be able to perform that service, and you would need to speak to a different consultant. So that's it from me on the SOCPA circular. And with that, I will invite my colleague Tariq to talk you through some of the e-invoicing insights and updates.
Thank you, Roman. That was a really useful insight on the SOCPA circular, and it's something that I've seen impacting sort of the clients that I've been working with over the last 3-4 months. And just a bit about what Raman's talked about. I've seen a bit of differing advice with the clients, where some of my clients have thought that actually, if the contract signed before the 1st of July, then the advisor and auditor can continue as they were beforehand. I've not seen anything from SOCPA or from ZATCA confirming that. So probably best to take a prudent approach and just to sort of ensure that there's a clear line between who's doing audit and maybe who's doing non-audit services. All right, so coming on to my topic, e-invoicing. It's a topic, it's not new anymore. I mean, it's been out 18 months. It was enforced on the 4th of December, 2021. Is it fair to say that most invoices or e-invoices that we see are non-compliant? Yes, that's fair to say, I think. I think a large majority of invoices are still non-compliant. So that raises a different sort of range of issues from a supplier side, from a customer side. And the ambiguity on certain areas continues. On your screen, you'll be seeing some bullet points of the type of things that we see commonly. There are other things as well, but these are sort of the most common issues that I'm finding anyway. There's ambiguity on e-invoicing details. So you have your supplier and customer addresses. There's up to a 9-line requirement in the guidance regulations for e-invoicing. But a lot of the time, I've very rarely seen suppliers put 9-line items for themselves and for customers. So it's an interesting one. And if you don't have the full details, it creates a problem, not from the supply side. It creates an issue from the customer side. And I'll come on to that in a moment. In terms of onboarding businesses, I think supply onboarding and customer onboarding, I think if businesses can get the onboarding process correct, it will make the life a lot easier going down the line, especially for finance teams. So you've got your salesperson, for example, they're onboarding a customer or supplier, whatever the case is. If they can get up to the 9-line items at that point, invoicing and any VAT issues are going to come out further down the line, the risk will be reduced. And what I'm getting, we've had a client a few weeks ago where ZATCA's assessed them on a non-compliant tax invoice. And it's interesting because they are reaching out to their supplier, but the supplier is saying, I can't send you a compliant invoice. My system is not allowing me to, or system's not set up to. So I think that shows, I'm not going to say widely, but I've noticed a lot of cases where suppliers are not able to generate a compliant e-invoice. So that leaves the customer in a very, very difficult position, especially where they're paying a large amount of VAT, which they cannot recover. So maybe maybe you want to step back and have a think about how suppliers are paid, obviously depending on commercial, realities. I know some clients, I'm not saying that we advise you to do this or not to do this, but I know of some clients that will not pay the VAT amount to the supplier until they get a valid tax invoice. So that's, something to consider, going forward, because it's impacting most businesses. The time and resources required to check electronic invoices are actually it's quite burdensome. That's my experience. I think internally for us to check an e-invoice, it takes between 12 and 15 minutes, because you want to double check, especially where there's large amounts of VAT involved. So it is quite a burdensome, check. So if any automation can be done in that area, or maybe you just check a supplier once, at least that will minimize the risk. For example, if you cannot check each and every invoice, then you may want to sort of have a mechanism by which you check a sample. I've got, issues around inaccurate VAT amounts and VAT rates. So we still see 0% on the invoice when it's out of scope. That itself, I've not seen to be a major issue, although from the supplier side, that's still incorrect. Discounts at line item and invoice level. If we know that invoicing has a line item requirement, and then you have figures that come at the end, which is invoicing requirements. Let's refer to them as invoicing requirements. And when you add up the line items, they have a total, of the line item. That also, there's a column for discount. So if you give a discount, you would put that at the line item level. So there's a bit of ambiguity on whether that discount will be reflected at the invoice level too. We think that's the case, but it is also equally arguable that they're complete two different discounts. The line item discount normally would, be for a discount for a specific good or service, whereas an invoice discount would commonly be for example, prompt payment discount or customer loyalty discount or whatever the case may be. That being said, there are instances where the supplier and customer don't agree on a certain position. For example, you've got a supplier sending out an invoice. They don't put the quantity for services, even though it's quite difficult to have a quantity for services, but most businesses would just put one. And then the customer rejecting the invoice, saying to the supplier, I'm not interested in this tax invoice because I can't recover it. And so some are taking a really, really strict approach, which is interesting. So look, my recommendation for all Saudi business is to sort of, have a look at your invoicing system as a whole. And I know it's been 9-10 months into invoicing, but I do think that there are ongoing issues. And if I was, one of the senior finance people, I would just make sure that everything is, sorted out before, there's an audit. Because I've noticed recently, although Zatka previously, historically, I didn't know them to make a big issue of invoices itself, but I have noticed more recently, I think it's easy pickings. If a tax invoice isn't compliant, it's said they can say, hey, here you go. Here's your bill, because it's not compliant. And it's very difficult for the person recovering input tax to bat back. There is some rules around alternative evidence, but it's generally not accepted in practice. So there's some of the key insights on this area. And now I'm going to pass it on to back to my colleague, Rahman, to talk a bit about transfer pricing, which is a real hot topic at the moment.
Thanks, Tariq. Yeah, transfer pricing, it's one of my favorite topics, or at least topic that there isn't a day when I actually do not discuss transfer pricing with my Saudi clients. It is that important now to all Saudi businesses. So to give you a background, the Saudi tax authority, Zatka, announced the transfer pricing regulations back in 2018. So it's been in existence for 4 years now. And until now, the requirements in relation to the rules and the bylaws were only applicable to, are only applicable to tax businesses or entities that have a foreign shareholder. However, a few months back, Zatka released its proposal by which it is hoping to expand the scope of transfer pricing to all businesses, that is the tax-paying businesses as well as the 100% zakat-paying businesses. So now, this is not yet formalized, but within business circles, the expectation is that it's a matter of when and not if these rules do come in. So it is going to be probably the biggest, along with e-invoicing going forward for the next 2 or 3 years. I think transfer pricing is probably going to be on everybody's minds and lips. Okay, so what is transfer pricing? Transfer pricing is a study that is employed by multinationals to justify the pricing methodology when on transactions with related parties. Now, I'm sure as you're all aware that the industry standard is that the price should be at an arm's length basis or market value comparable with third-party transactions. So the first question is, who is the related party? And this definition is pretty well defined both internationally as well as it's enshrined in the Saudi tax laws that parties are related if they are under common control or ownership. However, transfer pricing takes this definition one step further by introducing the concept of a connected party. So essentially, a natural person can be connected to another natural person by kinship. So for example, by birth, by marriage, adoption, etc. Moreover, if a natural person can exercise influence or partake in decision making, it is also connected to the organization. So broadly speaking, all of the categories I've mentioned above. So a person, whether it is a legal person or a natural person who is under common control or ownership, or who can exercise influence, is related up to the fourth degree, is a related party from a transfer pricing perspective. And that includes company directors as well. As you can imagine, this causes a lot of issues, and it's quite a tedious task to identify all of the related parties, because the simple fact is that if you're a multinational and you're operating in several jurisdictions, you may have hundreds, in some cases thousands of transactions, both within Saudi and outside. And this problem is further exacerbated by the fact that within the GCC, there are a number of family-owned and managed businesses. So you really need to really deep dive into identifying who is actually connected with that business and provide reasons for that. Once this exercise is done, then the next question is, how do you determine the market price? Well, you need to be able to justify it, and you need to be undertaking what is called as an economic or feasibility study. Some people may call it a benchmarking analysis, but essentially what you're trying to prove to the authorities is that the price that is being charged to a related party is the same price that would have been charged if that service was provided by a third party. Coming back to the rules that exist in Saudi Arabia with regards to disclosure forms and requirements. So if you have related party transactions, you're required to report those when you're filing your tax returns and potentially zakat returns in the very near future. In addition, if the value of those transactions exceed 6 million Saudi riyal per annum, you're required to maintain what is a Saudi specific local file. Without going into too much detail, it is basically a detailed summary of the business in Saudi Arabia, the organizational structure, the management reporting hierarchy, the sector itself, any external influences that may determine the price charts. So for example, the presence of competitors or government regulation and so on and so forth. So as you can imagine, there's a lot of technical detail that needs to go into the preparation of the file. And finally, you also need to summarize the identity of the parties and the price charge, which, as I've said before, must be supported by a benchmarking study. The other requirement is to prepare what is called a master file. It's a snapshot of the business at a global level. Generally, unless you are headquartered in Saudi, this file is would be prepared by the parent company, because they would have overall oversight of the various jurisdictions in which operations exist. Now, this is an extremely specialist area. I cannot stress this enough, that you really do need to have in-depth knowledge of how to apply the transfer pricing rules and where to look for when you're looking to do your feasibility analysis. Because if you get it wrong, it's a massive risk for the business, simply for two reasons. One, obviously the tax side of things. So if Zatka comes along and says that they disagree with your pricing methodology, they can amend your returns, and and you'll be subject to additional tax or zakat, as the case may be. And the other important thing, which is probably even more so for global businesses, is the reputational risk. I mean, if they are a global player, they certainly don't want, they want to be seen as a firm who discharges and meets the obligations of all the countries in which they do business. So, as I said, it really needs to be done by somebody who has in-depth knowledge of transfer pricing. Now, these files are required to be prepared and maintained annually and should be available on request by ZATCA within 30 days. And finally, for large businesses, so those businesses that have a global consolidated turnover of more than 3.2 billion riyals, are also required to file what is a country-by-country report every year to ZATCA. This report would have information on the entities, and my colleague Abhinaya will probably get into it in more detail when she does the CBC piece, but essentially you're required to provide some key metrics or ratios of performance. And the key thing here is ZATCA, rather Saudi Arabia, having signed up to international tax reforms, are obliged to share this report with overseas tax jurisdictions. And in this manner, the tax authorities around the world can monitor the business of an MNE and target any anti-avoidance measures they might employ. Keypoint is assisting a number of its clients with transfer pricing and continues to do so. As I said to you, it is a bit of a minefield, and you need to understand the rules, the implications to your business, and what you really need to do to be compliant, and so on. So if you have any questions on transfer pricing, please feel free to drop a line to any one of us, and we'll be happy to help. With that, that's it from my side on transfer pricing, and I'll hand back to Tariq, who will now discuss the ongoing Zakat amnesty.
Thanks, Raman, again. Most of you will be aware that there's a second tax amnesty going on. Well, the second one I've seen over the last few years. Very difficult to predict whether there'll be a third amnesty or another amnesty. So if I was the person responsible, I'd probably want to get everything cleaned up before this amnesty finished in good time. Okay, we've helped several businesses access amnesty over the last month. Process seems reasonably well managed. However, having said that, it doesn't take much for things to go wrong in Saudi. For example, you could have a technical issue. You could have issues resubmitting on the portal. It may be that, you know, when you submit, the penalty is showing or the penalty is not showing. And depending on, you know, for example, say you submitted a amended return, the penalties are normally automatically calculated, okay? So at that point, you would need to reach out to ZATCA to cancel those penalties. So from my side, there's not really much upside to delaying the process, considering there's just over 2.5 months to go. I've not seen any penalties get automatically cancelled, so they are applied and then it needs to be requested to cancel those penalties. At the moment, what I probably strongly suggest is to have a look across all taxes, identify the issues. Sometimes issues are quite complicated, so you may want to get someone else to check at a high level to see if there's any risks sitting within different business units. Even once issues are identified, it may be the case that it takes a lot of time to gather the required information. So you may need contracts. To check contracts, you may need to go to your sales team. You may need to go to HR. So you may need to be sort of connected with the wider business, which takes time depending on how large your organization is. Once you've identified all the issues and calculated any tax, then, you know, I've got clients who have a very lengthy approval process that they have to go through. It could be the case that head office approval is sought from an overseas country. So these things take time, okay? And especially if the payment or the amount is large, I'd probably want to get it done by the end of October, just with 1 month in hand. Like I said before, there's no upside to sort of delaying it. And in terms of accessing the penalty waiver, as it's done manually, It could be that Zakka takes time to do it from their side. So let's say, for example, we're into November, you resubmit an amended return, I don't know, 20th of November, leaving you 10 days. If there's a problem with the system or the Zatka is not confirming that the penalty has been cancelled and it goes on, say it goes into December, then it leaves the business in a very difficult situation. I think we had a business in the first amnesty that delayed it, and then what happened is they got stuck because the approval of the penalty waiver didn't take place, and it just created complications for no reward. So a couple of points from me around, technical positions, especially that have been taken, historically. Sometimes you'll get, well, actually quite often you'll get positions which are arguable both ways from a VAT perspective. For example, export of services is a pretty complicated area. And quite often, who the customer is from a VAT perspective, especially when there's more than two parties involved in a transaction, especially historically. For example, you could have agent outside, but you're dealing with parties inside Saudi Arabia, which may create some additional risk. So, you may be at the stage before even identifying the risk, you may want to actually go over any historical tax positions as a starting point. You may have had tax rulings, which, your team is relying on. But actually, if you go back, the facts may not be full. So even though you have a tax ruling saying, here's a tax ruling based on the facts, if Zakka was to uncover a fact that would change the tax position, it would again create complications from a business perspective. So my recommendation is, review any technical positions, any areas where there's uncertainty, make sure that you have a reasonably arguable position at least, and then do your analysis and get this process over the line in the next 6 to 7 weeks. So look, that's it from the tax amnesty side. I'm going to hand over to my colleague Abhinaya, who you've probably not heard from before, but as George said, she's one of our newly promoted assistant managers. And so she's sort of handling all areas of the business. And over to you now, Abhi.
Thank you, Tariq. Thank you, Raman. I will be providing you with the latest updates on economic substance and country-by-country reporting in Bahrain. As most of you know, Bahrain resident traders carrying out a relevant activity must demonstrate they have economic substance in Bahrain. So a list of activities which constitute a relevant activity for economic substance reporting purposes have been provided by the Ministry of Industry and Commerce in the ESR legislation. And this includes holding company activities, intellectual property activities, banking, financing activities, to name a few. So the official deadline for submitting the ES return on the NBR's ITIES portal is within 3 months of the end of the financial year. So this means that for 2021, the official deadline for filing the ES return ended on 31st March 2022, but entities are still filing their ES returns for 2021 on the portal. The MOIC has also been issuing violations to entities which have not filed the return for 2020 financial year. And recently, the MOIC has also been requesting for additional information in relation to business activities and related person details for 2021 and 2020 returns. So if you haven't assessed your ESR obligations in Bahrain yet, we recommend you do the same as soon as possible to avoid receiving a violation, fine, or suspension from the MOIC, or worse, being struck off. CR violations prevent CR renewals and other updates, including liquidations. So if you require any assistance with assessing your activities or filing your ES returns, we're happy to help. So now we'll move on to country-by-country reporting. The ministerial order was issued on 3rd February 2021, and which mandated the introduction of country-by-country reporting for the financial year ended 31st December 2021. So to assess whether your entity is impacted by Bahrain's CBC rules, you must first look at whether you're part of a multinational enterprise. A multinational enterprise means 2 or more entities that are tax residents in different jurisdictions, or a single enterprise that is resident in one jurisdiction and is subject to tax in another jurisdiction through a permanent establishment. The second factor to consider is whether the consolidated group revenue exceeds 342 million BHT, which is 850 million USD. If both the criteria are met, you're required to comply with the CBC reporting requirements. So the first reporting requirement is to file a CBC notification by the end of 2021. This means that all applicable entities should have filed a CBC notification on the NBR's ITIES portal by 31st December 2021. So if you meet the criteria for submitting a CBC notification, we recommend that you register your entity on the portal and submit the notification as soon as possible to avoid the consequences that are being displayed on the screen right now. The second reporting requirement is the submission of a CBC report, which must be filed within 12 months of the end of the financial year. This means that for 2021, the CBC report must be filed by 31st December 2022. That's the end of this year. Only entities resident in Bahrain that are also the ultimate parent entity are required to submit a CBC report. So again, if you require any assistance with assessing your entity's CBC filing obligations, please do reach out to us. We're always happy to help. Now I'll move on to the question and answers. So we'll read out the questions. The first one is, my company's external auditor also assists with VAT advisory services. Is this allowed as per SOCPA's new circular? Raman?
Thanks, Abhi. As I mentioned earlier, the circular is very specific in the sense that you are required to file, that the auditor can assist you with tax filing services. There's no mention of advisory and litigation, for the simple reason being that there can be issues around independence or conflict of interest. And therefore, as it stands, and by our reading of the SOCPA circular, advisory services are specifically prohibited under this circular. So if you have any advisory related services, or any ZATCA or litigations engagements ongoing, then you need to consult with your audit whether they can carry on performing the services. My guess is no, but best to check with them, because they are the ones who've been tasked to ensure that the SOCPA procedures are strictly followed.
We have another question on SOCPA. It says, currently we have the same firm providing both audit services and tax services to our registered branch in Saudi Arabia. As we're almost at the end of 2022, is it okay if we change our tax advisors from 2023 onwards? Yeah, Raman?
Yeah, the simple answer is unfortunately no, because the rules kick in from 1st of July. So if your accounting period ends before that date, then yeah, you could carry on availing the tax and audit services from the same consultant. However, if your financial year end is December, and I know that 95% of businesses in Saudi Arabia have a December year end, so if you're talking about the year ended 31st December 2022, as things stand, you're required, the audit firm cannot assist you on any tax advisory services, and therefore you should consult with them, and if need be, speak to a separate consultant for taxation.
Thanks, Raman, for that. So I'll take a few questions. On e-invoicing phase 1, are e-invoices required for nominal supplies as well? Then answer is yes. I mean, I'm assuming it's going to be a taxable supply. If that's the case and it's a nominal supply, then yes, e-invoice will be required. Will we be given sufficient time beforehand to prepare for phase 2 of e-invoicing. Look, how long a business needs to prepare will depend on the business size, the complexity, the type of activities it does, and there's many other factors. So my recommendation from phase 1 is, considering what I was talking about e-invoicing before, even though I think it was May, June last year in 2021, where e-invoicing guidance was being fed through from the ZATCA, and it's now a year and 3-4 months. And like I said, the majority of taxpayers that I'm seeing, or the majority of e-invoices I'm seeing, are not compliant. And so from that, I think the key takeaway is that although you can start preparing planning now for phase 2, I think it's a good time to just have a look at or relook at phase 1, especially if you've done something in-house, in isolation, and not had an input from an external party, just to make sure that what you're doing or how you're invoicing is working from a tax and an IT perspective is accurate and complete. There's a question around the amnesty scheme. We have over 1 million VAT to be settled. Can we ask for an installment plan? Look, there is a mechanism to apply for an installment plan. And there are rules around, when it needs to be paid by, when penalties will start accruing by. So there are some specific rules. So what I would suggest is that with your specific facts, to reach out to us or your tax advisor, just to see sort of how them rules will apply in your given situation. Abby, there's a question on ESR and CBC. Do you want to take those, please?
Okay, for ESR, we have a question. Does the ITIS portal still allow for submission of ESR returns for 2020 and 2021, even though the deadlines have passed? So yes, they're still accepting ES returns on the portal for both 2020 and 2021. But before you start the filing process, you will have to obtain the ministry's approval during the registration process on the same portal. So you will have to first register before you file for both the periods. Yeah. For CBC, we have a question: what type of information is required to be submitted on the CBC notification? So generally, it's information on the reportable entity as well as the constituent entity. So they ask for the name and few details about like their identification number, address, their activity types, etc. So it's information on the reportable entity as well as the constituent entities.
Abby, just a quick question. For CBCR, have you noticed businesses make easy mistakes on that? What have you found so far?
I mean, since the portal is still developing, there are a few areas where, they'll have questions on, what type of information has to be updated. So,
and what about in terms of penalties? I mean, I'm just probably asking on behalf of the audience here. Have we seen any penalties being applied?
So far, no. But yeah, if they don't file within the due date, it's possible that the ministry will come back and issue violations.
And do we know the consequences of that?
Yeah.
You want to tell us a bit about that? Sorry to catch you out. So look, everyone, this is Abby's first time, and so on a webinar, and so if she doesn't have an answer, that's okay. We know we can have a think about it, and it's a question for you guys to think about as well. I know sometimes when penalties are applied, there's some other wider ramifications for the business, maybe reputation, etc. So these are just some of the wider thoughts, and there's a few questions I'm going to take. There's lots of questions in the Q&A. I'll just go through some of them because some of them are quite complicated, and where that's the case, you might just want to reach out directly to us. Well, there's questions about the country and the city name on e-invoicing. Look, that's not going to be sufficient. It's not in compliance. So from a supplier side, you risk being penalized, and you also put your customers in a difficult situation if you knowingly provide them with a non-compliant e-invoice. And I was talking about this before. We've got one client where the relationship is become very strained because the supplier keeps providing e-invoices which are not compliant, and the customer cannot recover the VAT. So that's an ongoing issue. There's a question about whether we're covering VAT matters pertaining to Bahrain. Look, there's not a specific answer to that. What I will say is that, as George said at the start, VAT and tax is evolving rapidly throughout all GCC jurisdictions. So what I would say to that is that, for you to keep an eye, I mean, our job, part of our job is to keep, up to date with, evolving legislation, guides, insights. So if you're doing it in-house, then it's going to be difficult for you to stay on top. So you may want to connect with a tax advisor to assist you to keep up to date with these changes. Because if there's a change and you're not aware, then you could, you could be misreporting or underreporting, overreporting without knowing. So that's just something to think about. There's a question around e-invoicing for phase 2, and the person is saying that we're under the threshold. Does it still apply? Well, I touched on that a bit earlier. So what I would say to that is, I would definitely look at phase 1 again, and phase 2 would build on top of phase 1. So phase 2, keeping that in mind. Obviously, that's a direction of travel at the moment. And for sales turnover below SR 500 million, what is the deadline for phase 2 invoicing? Honestly, I'm not sure. As we are aware that the tax authority will give 6 months notice. So that's all I have to say on that at the moment. And with that, I'm going to pass it over to George with a few closing remarks and a few comments. And that's it from me. And thank you very much.
Thanks, Tariq. We've just run a couple of minutes over. We do tend to keep these sessions to 45 minutes, not to take up too much of your morning. But I think that's been, we've had a fairly full session because there have been a number of tax developments across particularly Bahrain and Saudi Arabia, and we hope you found these sessions informative. We have had a number of questions that we've not been able to get to or been able to answer for you, but we'll have a look through those and we will get in contact with you directly if there's anything significant there that we think that we can help you with. And from the other side, if you would like to reach out to us for anything at any point, all matters tax across the region, we'd be happy to help you. So thank you very much for taking your time this morning. I hope you have an enjoyable rest of the morning and the day, and we look forward to catching up with you on the next Tax Matters. Thanks everyone, have a great day.